All right, so you are welcome to part 2 of the partnership accounting. Now, we ended up the part 1 looking at the accounting for partnership. So let's continue from there. So we talk about accounting for partnership. All right, so this is where we continue from now. From where we left off in our part A or the part 1 of the class, we spoke about the fact that the exam can come in two folds. We said that there is a case where you'll be given the net profit in your trial balance. So we have situation where you'll be given the net profit or loss in the trial balance, or let's say the income statement value in the trial balance. All right. So in this case, the question will not ask you to prepare an income statement. Now, we also have a situation whereby the student will be asked to prepare an income statement by himself. So situation where you are asked to prepare income statement. So these are the two situations you might have. Now, from what we learned in the part 1 video, we learned that when it comes to the accounting for partnership, you realize that the first account we said we need to be preparing was what? Profit and loss account. All right. And this account is not prepared for the partners. It is prepared for the partnership. Partnership. What is the essence of preparing this account? The essence of preparing this account is that we want to know whether the partnership made a profit or what? A loss. All right. So that is that. Now, when we finish preparing the profit and loss, we need to share the profit to the partners. And so therefore, there is a need to prepare another account we call what? Profit and loss division account. So some call it division, some call it appropriation. So wherever you see it is the same thing. All right. So this is what we do. Then the third account that we will be preparing will be what? The balance sheet. The balance sheet. So we have the balance sheet. Now, we do know well that in preparing balance sheet, we learned that balance sheet, we have the asset part, we have the capital part, we have what? The liability part. Now, in this balance sheet for a partnership, this is where the issue is. When we get to our capital account, we will have to split the capital account into two. So the first part of the capital account will actually contain the real capital. So we are talking about the capital. All right, the capital. So it will contain the capital account. All right. Then the second part of the capital account will contain the partner's current account. The partner's current account. So therefore, when it comes to the preparation of the balance sheet, that gives rise to a situation where we have to prepare a capital account and also a partnership current account. So if you have to prepare a partnership account and at this the capital account, and at this when you are done with that, go and prepare a partnership current account. It is called the fixed. We have two ways of keeping the capital account. This one is the fixed. So this one, it means that the entity will prepare a fixed capital account. Nothing goes in there. So what remains inside this account are only two things: the capital contribution, and two, any withdrawal of capital. So these are the only two things that goes in there. So you keep a fixed capital account. If you keep a fixed capital account, then you also keep a separate current account. We will look at the format of all these accounts that we are talking about. All right. So when you look at the format of also the current account. Now, I said that if you are to prepare a capital account that is separate from the current account, we call it what? The fixed capital account. But if you have a question where the question says that combine the capital account with the current account, it means these two will be everything that is here and everything that is here will be put together. And when you put them together to prepare one account, it is called the fluctuating or the flexible capital account. The fluctuating or the flexible capital account. So it therefore tells you that a situation where you prepare a capital account separate from the current account is called fixed capital account. A situation where you prepare a capital account combined with the current account is called fluctuating capital account. All right. So this is it. Now we are going to go straight in and do the presentation, the format of the profit and loss account. We have already learned how to do P&L. Of course, you have your sales, less cost of sales, which includes what? So if there is sales, there is return in what you will deduct, right? Then what else? When you look at your, after doing your sales and minus any return was, what do you normally do? Less cost of sales. Your guess is as good as mine. All right. In the less cost of sales, what do we normally have there? Opening stock, add purchases, right? And one thing you should understand is that a partnership account can be a manufacturing account. So you bring in the knowledge from manufacturing. So if it is add purchases, a trading account you will do, but if it's a manufacturing account, go and bring the production cost or what? The market value. All right. So what do you do again? If there is any carriage in what you go ahead and do, okay? These are things we learn in the final account of a sole trader. All right. You add your carriages. If there is any drawings, you deduct drawings. When we deduct drawings, what do you get? Cost of goods available for sale. All right. If it's a manufacturing account, what do you call that? Cost of goods, all right, available, all right, for. So if in the manufacturing account and you do it in the manufacturing side, it is cost of raw material available for use, all right. So that is that. So now you go through all those things, you less your expense, you get your profit and loss, then that is it. But appropriation is something that is new. So let's look at how we present the appropriation. Now, I'm going to present the appropriation to cover these two situations, where in the case where you are giving the net profit in the trial balance, and in the case where you are asked to prepare the income statement yourself. All right, so let's look at the format. We learned in our part one how to adjust the net profit. You remember? So we do the adjustment of the net profit when the income statement is given in the trial balance. We didn't do the P&L. The question did it and gave it to us. So if the question did it and gave it to us, then if there is any adjustment, we will do. What goes into the adjustment? I hope you remember. I hope you remember. Yes, we learned that in the first video. Exactly. So this is what we have. If you remember from the first video, we said that you prepare the appropriation account. You need the name of the partners. Then you prepare a profit and loss appropriation account. Now, if you have the net profit or the income statement given to you in your trial balance, then you bring it in. Then you do some adjustments, all right? You do some adjustments. So I explained to you why we actually add goods taken from this illustration that we did in the first video, all right? Then I said that you will less what? Interest on loan, because interest on loan is a charge against the entity's profit, and any expenses that is also done by the partner on behalf of the partnership. Why? He did it on behalf of the partnership. So the partnership will owe him money, but the partnership has also incurred an expense. So there is an expense incurred by the partnership, but it was paid by a partner. So it means the partnership, all right, will owe that person money. So we less those expenses, all right. So that is where we got to in terms of dealing with what? The appropriation, all right. So today we are going to go on and copy this part again, then we will explain the additional things that we have put here, all right. So sitting tight, let's start all over again with the appropriation. All right, so we start again with our appropriation account. So we said that in the appropriation account, we will need the name of the partnership. Then you'd write profits and loss appropriation account, which is also called division of profits, all right? Appropriation account for the year ended, for the year ended. Then you put your date there. Underline it nicely. All right, you underline it nicely. Then you put your currency. 2 is fine. So we said that you bring what? Your net profit. All right. So this case is either you calculated for or it is given to you inside the trial balance. Now, if it is given to you inside the trial balance, that is where you need to be careful to do some adjustments. So you do your adjustments. What goes into the adjustment? Key ones are that we need to add what? Drawings of goods. All right. Add drawings of goods, not of cash, but of what? Goods. So you add it. So you get this figure. Then we said you less what? What do you less? You remember any expenses made on behalf of the partnership by a partner, and also what? Interest on loan. Interest on loan. So with expenses made on behalf of the partnership by a partner. So we combine those two together and we take it out from this. So what we have here will be our adjusted what? Net profit. This is what we have. So the next thing we need to do now is to add the appropriation part. So the main appropriation part goes like this. So again, we are looking at the fact that some people would take money, all right, and we call it drawings. Okay, so whether it is drawings of goods, whether it is drawings of cash, whenever you do drawing, here we are looking at something like even you any form of withdrawal that happens in there, the partnership will charge you interest. So you have to pay that interest to the partnership. Now, if you pay that to the partnership, what is happening? We are increasing our cash, our money, our profit, right? So that is that. So that is the reason why we will add what? Interest on drawings. So interest on drawings. All right. So we need to add that. So let's say, let me do it like this. Let's say all the partners. So we have the interest on drawings partner A, of partner A, and of partner B. We put them together. All right. So that is what happens. We will add to this. All right. Then we have any interest on current account, interest on current account, debit. Interest on current account, that is a debit. So if your current account is a debit balance, it means there is an overdraft, like a loan or like a drawing, all right? So we will do that interest on that current account. That is a debit what? Balance. So that one too, let's say partner A and partner what? B. You put them together, you will add it. So you will add 1, 2, and 3 together. So you put them together. All right. Then what are the things we deduct? The things we deduct, so we will less what? We will less something like interest on capital. Why do we less interest on capital? Because the capital is given by the partner. And so it's like the partner give the partnership money and the partner is taking interest. So when the partner is taking interest, to the partner, it becomes an income. But to the partnership, it is money they are paying to the partner, and that is going to reduce their profit. So we need to reduce the profit with these things before we share it, so that everybody has taken a share. The partnership has also taken money that he has to take. Then we have a correct net profit we have to share. So the interest on capital, so if partner A does, partner B does, we put them together and we deduct from this. Not only this, another thing is that just as we did the current account debit, we will do interest on current account. That is what? A credit. Your guess is as good as mine. Current account, that is what? A credit balance. So that one to partner A, partner B, we put them together. All right, then we take it out. Then the last thing is salaries to partners. Salaries to be paid, whether paid or to be paid. Remember, accounting is on accrual basis. So whether you paid it or, all right, whether you paid it or is to be paid is part that we need to deduct, so that we will actually have them actual balance for the partners to share. So salaries to be paid. All right, so if partner A is to be paid a salary, we take off. Partner B is to be paid a salary, we take off. We put them together, then we deduct. All right, so we put these three things together, or we take this and less all these three things, and we will have what? Profit to share. So the profit available to be shared. Now, one interesting thing is that there is something called the partnership deed, and we learned something about a situation where there is no partnership deed. For example, if there is no partnership deed, the law says that you will calculate 5% as interest on any excess capital. Remember, for example, if there is no partnership deed, we said that all capital must be contributed what? Equally, and so profit and loss should be shared what? Equally. But the law also says that assuming there is no partnership deed, which means profit and loss are supposed to be shared equally, capital contribution is also what? Equally. So let's say partner A contributes 500. It means that partner B is also supposed to contribute what? 500. Now, if partner B rather contributes, let's say 600, then it means that partner B has contributed an excess of how much? 100. And this 100 he has contributed, he will take a 5% what? Interest, which is, so 5% of this is what you are going to take, like 5. All right, so that is what, which is equal to what? 5. Now that would have been interest on what? Excess capital. So you put that here. And this happens when there is no what? Partnership agreement. So be careful. Anytime the question says there is no partnership agreement, you need to look out for a situation whereby somebody contributed more of the capital than everyone else. And the excess, you will do 5% on what? Capital. Remember, when there is no partnership, there's no interest on drawings, there is no interest on current accounts. Everybody is engaged as part of the management of the entity. All right, so remember all those things. So now, we now need to share this profit. So we are going to share them. So we have sharing of profit. Now, in the sharing of profit, let's say the sharing ratio is, let's say, 2:3. Then it is going to be like partner A will take what? 2/5. Is that not it? Because the total is 5. All right, you do that, multiply by the ZZZ here, the figure that you have there, and you put a share over here. All right, then B will be what? 3/5 multiplied by ZZZ. Then that one, you put it here. This is a balancing figure. But here you need to take note of what we call guarantee. Guarantee. What is a guarantee? Sometimes one partner guarantees the minimum. So we are talking about guarantee minimum for the other. So for example, you are a partner, so we are both partners. I said, let's go to campus to Dr. Rita. When we get there, she will give us money. When she told us she will give us money, and she told me he will give me 1,000, and you that I'm going with also what, 1,000. So, and you are the person that I'm going with is kind of in doubt. Then I tell the person that you don't worry. Whatever be the case, I guarantee that by the time we leave Dr. Ritter's site, you are going to obtain 1,000. So A guarantees to B that whatever be the case, you B, you will have 1,000. So let's say we go and Dr. Ritter gives B 800 and gives A 1,000. What happened there is that B is short of 200 because you guaranteed B that you give him 1,000. In that case, it means that this guy B must have 1,000, hook or crook. Where would that 200 come from? The 200 will come from A, meaning that A at the end of the day will have what? 800. Then B will rather have 1,000. Because why? A guaranteed B that he would definitely get a minimum of what? 1,000. So what if when we go to Dr. Ritter's office and Dr. Ritter gave B 1,002, or let's say 1,001? In that case, he has already exceeded the minimum and nobody will add anything to B. All right. So after you've considered the guarantee, you shift the right figures here and you balance it off. All right. So that is how we do the appropriation account. Take a look at it because very soon we are going to go into question solving. All right. Now, what I'm going to do next, so this is income statement and appropriation. So we said that the next thing for us to do is to do a balance sheet. You already know how to prepare a balance sheet. And so the part that I'm going to infuse in is the partnership current account. All right. So let's learn how we do the partnership current account. So the partnership current account or the partner's current account is what we need to prepare now. So you draw it very nicely, your lines very nicely. And in the illustration that we just did, we had only 2 partners. So if there are 3 partners, create columns for them. So you have this, Just make sure it fits into your answer booklet or your exercise book. Well, all right. So we will have partner A, we have partner B, partner A, partner what? B. All right, so that is what we will have. All right, we will put our currency sign. Don't forget that it gives you some marks, all right? And this place is for your detail or your particulars or description. All right, so basically that is that. So here we start. So you will look at the information that you have. You will bring in your balance brought down. So you check the current account of the partners. If the current account of the partners is a credit balance, then you will slot them in here. But what if it is a debit balance? If it is a debit balance, look at the position of that in the trial balance. If it is debit, please put it at what? Debit. All right. If it is at credit, put it at what? Credit. Now I'm going to show you a shortcut. The things that comes after this is the debit side is particularly drawings. And please, the drawings, whether cash or what? Goods. So you put it here. Whoever does such kind of drawings, you deduct from their current account. So that is that. Now, things that are decreasing the current account are at the debit, and things that increase the current account are on credit, because current account is what? A credit account. All right, so take note of that. Then once you're done with this, you see all those things we added here, all those things that we added. See, you saw this interest on drawings, we added, so add drawings of goods. You saw drawings of goods where I've positioned it, but here we don't do cash in P&L, so that is why you don't see drawings of cash. So I didn't be that cash was good. Yes, you go and deduct the drawings. All right. So like we did. Then this interest on drawings, what we've added. So you realize that the things we add here, we will go and put them at the debit side. All right. So we have interest on what? Drawings. Interest on drawings. So you reduce that one too from this side. All right. Then interest on loan, you remember these are things we less, right? On loan, whoever is taking that, you put it under his column. And then expenses spent on behalf, right? Spent on behalf of partnership. Whoever did that, you put it under his name. All right. What are the other things? Yes, your guess is as good as mine. Interest on capital, right? Interest on capital. Yes. What else? So interest on capital, then we have what? Interest. What was the other one? Interest on current account credit, right? On current account credit. So we have also here interest on current account what? Account debit. So whoever has that, put it under their names. All right. There is one last thing here to come. Who can see that? Yes, you are right. So we have what? Salaries. So after the salaries, there is something else, right? The share of profit or loss. That's a good way of thinking. So if it is a share of profit, then we will bring it here. Share of profit. You will bring it what everybody gets. All right. If it is a share of loss, all right. So what everybody gets. Now, when we finish like this, we need to total them and find out which part is bigger than the other. You learned that last semester, right? So in the old videos you can search for, you realize that those ones too were there. So now what do? You balance of the account. So be careful. The thing is that the balance carried down can be here. The balancing figure, it can be here. It can be at the, what do you call it? The credit side, or it can be at what? The debit side. So remember how we used to balance accounts, okay? So if it is a share of loss, sorry, it is already here. So the next thing that may come here is maybe the balance carried down if it is a debit balance. All right. So the balance carried down. If there's such shortage, it should be at the debit. All right. So we total everything. And like, as you know, balance carried down here becomes what? A balance brought down here. So these ones, all right. And a balance carried down here also becomes what? A balance brought down over here. All right, so this is how you need to, once you're able to do this current account, then you can go ahead and prepare your balance sheet. I know you know the format of a balance sheet already. Yes, you know the format of the balance sheet already. So what do we do? Name of partnership. Then balance sheet as at. As at. All right, you put the ending date. So you underline perfectly. Now, we just need to remember how we used to present balance sheet, all right? So we create 3 columns. So don't forget we have our fixed assets. We create what? Costs, accumulated depreciation, and what? Net book value. We bring in our currency signs. Never forget that so that you don't lose ticks. All right. So the fixed asset, what do we have? Any land and building. Remember, land is not depreciated, but building might. So you take the cost from the trial balance, you less accumulated depreciation, then you get your net book value. So the same thing, land and building. If there is any motor vehicle, what do we have? Equipment, office equipment, which might include computers. We have what? F&F. All right, so you do for all of them. You take off their accumulated depreciation, then you get your net book value. So you total that side. All right, so that is what you do. Then you come to what? Current assets. All right, so current assets, what do you remember? Inventory, right? Closing inventory. Then receivables. All right, then any prepayments. Then what? Cash and bank. All right, so if you have those ones, all right, you sum them together. You sum them together, you get your total current assets. All right, now when you get your total current asset, you now need to less what? Current liabilities. That not it is. So let's less our current liabilities. All right, so the current liabilities, what do we have? We have trade payable, right? We have all forms of accruals. All right, the accrued expenses. Then we have bank overdraft if in case. So when in the trial balance, when bank is at the debit side, you put it here. When bank is at credit side, it's an overdraft. So you put these together and you take it off. So don't forget, we less current liabilities. Then what do? You take it off. All right, you take it off. So we take it off, we get what we need to get here. This is called capital employed. All right, next, finance by. So this is the first balancing figure. Then we come to represented by or financed by. So financed by capital, right? So here we have our capital account. All right, so of each partner. So partner A, B. All right, so let's go back a little small and let me show you something. So like we said about the fluctuating, assuming we are supposed to prepare a fluctuating account, which means that we need to combine the capital account and the current account together. This balance you have here will be your capital account plus your current account balances. The same thing happens here. So that is the only thing. And if they withdrew money from the capital account to, if the capital account is supposed to be a credit balance, so it's supposed to be here. All right, credit balance. All right, so if there is any withdrawal from the capital, you will debit it. All right, so that is that. So you do balance brought down, colon, capital account, then you put them here. Then balance brought down, colon, current account, you continue. So everything will be inside. All right, but the current account can be debit or credit. So you have to be very, very careful. All right, given the position in the trial balance. All right, so you bring the partner's capital account, you bring them in. So we have this, and we have this. You put them together, you slot them here. Then you bring in the current account, the closing balances of the current account. Where can we find the closing balances of the current account? Do you remember the balancing that we did? So you take partner A and partner B. So when you do that, you go to the current account and pick the closing balances on the current account. Where are they? So let's go to our current account, these ones, right? So those ones that are here. So here. So depending on which side it is, all right, you bring them in. Okay. So you pick them and put them together. Once you put them together, you will have your capital. So you have your capital, the finance by part. Then once you are done with the finance by part, the capital, the last thing we need to bring in is what? Long-term liability. Your guess is as good as mine. So we have long-term liability. So the long-term liability, what do we normally have? Loan, right? So when we add the loan to the capital, we should balance completely. So that is how you prepare a balance sheet. Now, what we're going to do next is to just pick up a question, our tutorial set questions, and run through it. Don't forget, this thing is balancing. So this side should be something like this, should be equal to what we have here. That is what we call balancing of a balance sheet. All right, so next, we're going to pick up our tutorial set and start solving the questions. Are you ready? Get ready for me. So let's pull up the questions and deal with it. All right, so we have our first tutorial set question 1, and we're going to do that. So this one says that Kako, Kobe, Kero started partnership on January 1, 2021, sharing profit and loss, all right, in the ratio of 3:2:1. Now, it says that according to the partnership agreement, this means that there is partnership agreement. So it says that according to the partnership agreement, partners' capital account and drawings will attract interest, okay? So it says that also Kako guaranteed Kero a minimum share of profit of 5,100. Remember, we've explained that. So it means that hook or crook, the minimum of 5,100 he has to get. The trial balance of the partnership as at 31st December, after preparing the preparation of the income statement for the period is as follows. So that is what we have: the capital account of the 3 people. We also have the current account of the 3 people. Then there's a loan. Then we have the income statement. So the income statement, another name for income statement, yes, the profit and loss. So it means that this is our profit they had after preparing the income statement. We have asset, building, office equipment, inventory, receivable, cash in hand, and what? Motor vehicle. So there's also trade receivables, which should be at the credit side. Now it says that the following entries have not been made in the books. So these are things that they have not done. So it means we have to what? Do it. Now, one thing you need to understand, I always tell you guys, is that these additional information have double treatment, which means they must appear twice, all right? So the effect of this transaction is double what? Treatment. So they must appear twice. No, sometimes the same figure, sometimes the effect of it. But the thing is that you have to treat it on 2-leg basis. How are we going to do that? We will see when we are solving this question, all right? So we said that monthly salary is to be paid to Kero. So this is not a salary to employee. This is a salary to the partner. If it's a salary to employee, where do you treat it? Yes, the profit or loss, all right? So that is that. Then general expenses of 3,750 to be paid by Kobe personally on behalf of the firm. So that is it. So he made some expenses personally, all right, on behalf of the partnership. Remember that. Then we have cash drawings made by the partner. It's cash drawings, so not goods drawings. So these are the things. Then we have goods drawings, all right? So you see, goods drawing, we learned that it's supposed to be part of the income statement. And these are things they did not do. So if they didn't do it, we will do it, all right? Then we have interest on drawings, we have interest on loan, another one. So this thing is supposed to be inside the income statement. So if they didn't do it, we will have to do the adjustment. Then interest on capital. So we have these 3. Then it says that capital account will be maintained as fixed. So if it is fixed, don't forget, then it means that we need to prepare a separate what? Current account. So you've been asked to prepare a profit and loss appropriation after adjusting for the profit with the information above. Then lastly, we are asked to prepare the partnership balance sheet All right. You see, in the question, we were never asked to prepare current account, but current account is a working that you must always do. All right. You must always do it. So let's go back, prepare our appropriation account. So we have to start here. What's the name of the partnership? So we have 3 people. All right. So we have Kako, Kobe, and Keru. All right. So the next thing we need to do is to establish our partnership appropriation. So partnership appropriation account for the year ended. So this one will be 31st December 2021. So that is what we have. So we have Kako, Kobe, and Peru. Then we have profits and loss appropriation. Account for the year ended 31st December 2021. So that is the requirement of the question. So you always check the requirement of the question, all right? Now, so how do we start? We put in our currencies nicely. If there is the need to put zeros at the top, just do, all right? But in this case, we have nothing like that. So we start with our net profit or our income statements brought down. It's at the credit. That's why I know it is a profit. If it's at the debit, it's a loss, all right? So how much is that? 58,000. And we need to do adjustment because there were certain things that were supposed to be done that weren't done. So we need to do those things. So what do? We add, remember the 2 goods. Goods are normally deducted from purchases. You should remember that thing we did in the first video. So if you've not watched the first video, take time and go and watch the first video. So you add what? Drawings of goods. How much is that and who took that? So that drawings of goods was done by who? Kako. So how much is that? We have 17,500. Now, when we put this thing together, we have 70 what? 75,500. So that is what we have. Then we less what? The interest on loan that should have been done, that wasn't done. Who gave us that? The interest on loan. Who gave us that? The interest on loan was Kero. So we put Kero's name. How much is that? Interest on loan, 5,000. Then the expenses made on behalf. We know general expenses is a P&L item. So general expenses, that should have been done. So general expenses is what? And who did that? Kobe. And that is how much? 3750. So put together, we have 8750, which we are taking away from this. And that is 66 what? 66,750. So that is what we have in there. Where is my other calculator? Let's punch it together. So we have 75,500 minus 8750. So we have 66,750. This is our adjusted what? Net profit. Then we do the appropriation part. What do we normally do to appropriation part? Good. We add interest on drawings. So add interest on drawings. Who did drawings? So interest on drawings, we are told that both Kako, so all of them did, Kobe, then Peru, interesting names, right? So we have 1625, we have 875, then we have 500. This put together is definitely 3,000. So that is what we have. Normally, what else do we need to do again? Interest on current account debit. So you look inside here, current account debit. These are their current account. You see, Kobe has a debit. All right, but is there an interest they told us we should calculate? So we don't have any percentage for that, so we leave it like that. So assuming the question has given us a percentage on current account, so we will use that. So this we are done here. We have what? 69750. That is what we have. Then what else do we do? Appropriation, we less. Less what? Yes, it's good to remember. Interest on what? Capital. Interest on capital. What are the interest on capital items that we have here? So these are the interest on capital items. So you bring here Kako, you bring here Kobe, you bring Keru. Now we have 12,500, we have 11,200, we have 10,000. So if we add these three things together, what do we have? So if you add, you see it's clear, 33,700, right? 33,700. Don't forget, we will be deducting. What else do we deduct? Interest on current accounts, credit. We don't have a percentage, so we can move on. Is there salaries to be paid? Yes, we have salary to be paid. And that is what we have here. A monthly salary of 625 is monthly, so it means we need to do 625 by what? 12. And that, who is receiving that? Keru. And that is Kehuro. Kehuro is receiving salary of what? 7,500. So that is 625 multiplied by 12. It's monthly. So there are 12 months in a year. So you do all these. Now, when you subtract from these, what you will have is that I have 69750. I take away 33700. Then I also take away my 7,500. And that gives me 28,550. We need to share. So this is our profit to share. All right. So profit available for sharing. So let's share. So we do sharing of profit. We were told that the profit and loss sharing ratio is what? 3:2:1, right? So what do? So we take like the names. So Kaku, we take Kobe, we take Kehuro. So Kako will be 3 over what? Yes, 6. That's good of you. This will be 2 over 6. Then this will be 1 over what? 6. Where did we get the 6 from? It is 3 plus 2 plus 1. So that is what we have. We are sharing it. So we multiply by 28,550, by 28,550, by 28,550. Now, it is good you present your answer in the second column. So let's present that. So this one is 3 over 6. So we have 14,275. Then we take 2 over 6 by 28,550. That one too, we get 9516.67. That is what we have. All right, you can round it, but you have to tell the examiner you rounded it. All right, so the last person also have what? 1 over 6 of that. So that one gives me 4758.33. Now, once you are done with this, remember, Kehuro was guaranteed what? 5,100, which means that hook or crook, he should get what? 5,100. So for him, he has to get his 5,100. What is the difference between this and 5,100? The one he had and 5,100 is 341.67. Who guaranteed that? Kako guaranteed that. So it means we need to take 341.67 from Kako's own and give it to this one. So that is what we've done. So as for Kobe, he is safe. So he has 16.67, right? All right, 67. And as we have taken this figure from Kako's own, what will be his? So when we deduct, I'm having 13,933. So 13,933.33. So this one is 0.00. So we total together, we have our 28,550. So we balance it up like this. The next thing for us to do is to go quickly and do our balance sheet. And before we can do balance sheet, don't forget, we need to prepare our current account. So let's prepare our current account. Quick. So partners current account. So we have partners current account. So in the partners current account, what do we have? We need to draw it nicely. So I will need more space. So make sure you draw it nicely, okay? So divide it very well. There we have 3. So the one that divides the 2 lines, try and do a nice lines to divide those ones into 2. So we have 3 partners. So I do it like this. All right. Some people like taking route to the exams hall just so that they can draw. But in as much as you do that, make sure you don't waste time. All right. Your hand can also draw nice lines. All right. So like I've done here, it's nice enough, right? Yes. So I draw and I put here Kako, Kobe, then Kehuro. Kako, Kobe, and Kehuro. All right, so I put out my currency signs. This you must do so that you can at least get some text. Okay, so once we are done with it, we start fixing in the things as fast as possible. So we know we have the balances. So the balance, balance brought down. So the current account. So assuming we are preparing a flexible one, this one question says that current account is capital account is to be remain fixed. So it means we have to do the current account. Assuming we were supposed to combine the two. So this balance brought down would have recorded all these figures. All right, together with the current account. So the current account, we have Kaku 40,000. Kobe doesn't have it here. Kobe has it here. It's a debit. So Kobe's own, which is what? 10,000 is a debit. Then we have Kero's own, which is 22 what? 500. So that is what we do in there. All right. Then what do you remember? Drawings, right? The drawings they did. Where are the drawings? The drawings, they did drawings for goods and cash. So for the goods drawing, only Kaku did it. So Kaku, 17,000. Oh, that is, I'm putting it under cash. So for goods drawings, only Kako did it. So you have this. All right, nobody did goods drawings. Then cash drawings, all of them did. So we have here 15,000, 10,000, then 7,500. All right, so that is that. Interest on drawings, do you remember? So like I told you, all the things you see. All right, so let's fix it like this. All the things that were added is at the debit side. So interest on drawings were one of them. Interest on drawings. So let's go to our interest on drawings. What were them? So this Kako is what? 1625. All right, then we have 875. Then we have 500. All right, so that is that. You remember the things that came here? What? Interest on loan, right? Do you remember the person that gave the loan was what? Kevro, so 5,000. Then what again? The expenses, general expenses spent, all right, on behalf. All right, I told you those things you less is at the credit side. All right, so who did that expense? The general expense, that will be Kobe. So Kobe, you put in here 3750. What else? Remember, interest on capital, right? How much is the interest on those capital? So interest on capital, we have 12,500. What else? 11,200. Then we have how much? 7,000. Oh, no, 10,000. All right, so that is what we have there. That is what we have there. Then what else? Interest on current accounts credit was in part. Then what else? Salary, right? So who took the salary? Let's check who took. So salary is who took the salary? Where are you? Where are you? Where are you? Where are you? Kehuro took the salary, and salary is 7,500, right? We multiplied by, all right, 7,500. Okay, so this guy, the general expenses is not for this guy. The general expenses is for who? Kobe. So this is Kobe. So Kobe should rather have the general expense. So be careful. You see how I can even make a mistake in there. Then what else? Share of profit, right? Share of profit. When we share the profit, what were the figures? So share of profit, this one is 13,933.33. Then this one is 9,516.67. Then this one is 5,100. All right, so looking at the debit and the credit side, what do you think, which side do you think has more figures than the other? And the total, in terms of total, you clearly see that at a glance, the credit side has more than the other side, right? So let's balance it off. Fast with that. Now, what do we have in here? So it means our balance carried down will be here, and definitely, therefore, we have our balance brought down here. So it can be any other place, all right? So let's combine this side. So we start here, 22,500 plus 5,000 plus 10,000 plus 7,500 plus 5,100. I have 5,100. I don't erase it from my calculator. Immediately, I know these two is 8,000, right? So I can just do minus 8,000, which tells me that my balance carried down here is 42,100. So 42,100. And that is the one that will go to my balance sheet. All right, so I do 3,750 plus 11,200 plus 9,516.67, and that gives me 466.67. Oh, sorry, that's very bad. So it's 24,466.67. 24,466.67. So I keep that on my calculator. I know when I add these two is 20. So 2875. So minus 2875. So that gives me 3591.67. So 3591.67. And that is what I have there. Then the last one, we have 40,000 plus 12,500. When we shared here 13,933.33, and that gives me 66. Sorry for this lines, 433.33. Now, if I get that and I now deduct 17,500, all right, I deduct this minus 15,000 and minus 1625. What I have is 32,308.33. So that is what I have. Then I prepare my balance sheet straight away. So we have Kako, Kobe, and what? Pehuro. Balance sheet as at. So the sheet didn't appear, Abby. So find a place there. As at 31st December 2021. All right. So we have cost, accumulated depreciation. Do we have all those things in this question? We don't have that. So I think we are giving the net book value straight. So let's go straight. We don't need this. So we have let's erasing is a problem. So let me just delete this. Wow, it's not even going, which means that, all right, let me delete it. Okay, so now I put in my CD signs. So fixed assets, we have so many fixed assets, but there's no accumulated depreciation. So what do we do? A fixed asset, we have land and building. Which gives me 500,000, right? So we have 500,000. Then what else? Office equipment. So before office equipment, in terms of durability, we have motor vehicles. And here is what? 162,500. Then office equipment. How much is that? Office equipment, 37,500. If I add these three, I think that looks 700,000 straight. Let's move. All right, so that is what we have. I come to my current assets. I saw inventory, so the closing inventory, this is it, 87,500. That is what I have. Receivables are there, and that is 67,500. Then what else? Cash in hand is also there. Cash in hand is a debit, so we can add that cash in hand. So here is where you need to be very, very careful. You see this cash in hand, it is 52,500. Don't forget that in the footnote where I told you things are treated twice, there is drawings of cash drawings. So all those cash drawings that happen, you need to deduct, all right? Just as you deduct the goods drawing, you know the goods drawings, I told you it is treated twice. Now, let me show you something. Before I forget, let me put 66,437.33. You see, all these things that are in the footnote are appearing twice. One will be in the income statement, or the appropriation. Then the other one will be what? In the balance sheet. Now look at this. For example, monthly salary. Monthly salary, we treated it in the appropriation. Is that not it? Salary. That was 7,500, right? And how does it go then also into the balance sheet? It is here, salary. And we said that the balances here will go to the balance sheet. So it is going to the balance sheet through what? The current account. Check the general expenses. It's also in the P&L. It's also in the current account. That's how it will go. But cash drawings, it is only here. It wasn't in the P&L. So it's left with one treatment of it. So all those cash drawings, that is how we are going to carry them. All right. My machine is kind of freezing. So that is how we are going to carry all those cash drawings over here. It is a drawing, so it is a subtraction. So now let's subtract it from our cash. They took cash. So let's subtract all the cash they took. So how much did they take? They took 15,000 plus 10,000, that's 25, plus 7,000. That makes it what? 7,500. That makes it like 32,500. So if they took 32,500 from this, the balance is what? 20,000. Is that not it? 20,000. So that is what we will have. So just be very, very careful. All right. So this is how much? 8,7,500 plus 6,7,500 plus 20,000. That gives me 175. So I have 175,000. Less what? Current liability, right? So what are our current liabilities? We have trade payable. Is there any other accruals? No. So we are going to less our trade payable, which is what? 72,000. All right. So minus 72,000. That gives me 103,000. 103,000. So 803,000 is my balancing figure. So this is capital employed. So let's go to finance by. And here we said that we will divide the capital side into two. So we start with the capital account. We didn't need to prepare a capital account because this is just the figures here. So we have 250 and what else? 225. So you list the partners. We have Kako, Kobe, then Kehru. All right. So we have 225,000. Then we have 200,000. That is like 675, right? So 675. Then we come to the current account that we prepared. So that one to Kako, Kobe, then Kehru. So, what was the figures we had? What were they? All right. So we have 32,308.33, 359167, and 42,100. So let's slot them in. So we know that this one is 42,100. And the last one is, the first one is 32,308.33, right? And this one was 3591.67. So let's put them together. All right. So we have 32,308.33 plus 3591.67 plus 42,100, and that gives me 78,000. So that is my capital side. So plus 675,000 will give me 753,000. It's not balancing yet, but there is the long-term loan. Long-term loan. How much is the long-term loan? Kehru. So with Kehru, we have 50,000. So now if I add plus 50,000, I have the balancing figure of 803,000. So this balance perfectly. All right. So this is good. Keep doing it. We will look at our question 2 under tutorial note 2, which is this, in the third video and that one will do the question 3 also. Then later on, we will look at how do you go about it when you are admitting a partner, all right, or when a partner is leaving, all right. So watch out for part 3. Let's solve the tutorial questions 2 and 3 in that video. Keep practicing, and I will see you soon. God bless you, and have a good day.